This chapter is cost of capital. It is the most important concept in corporate finance. The theory of corporate finance was established in 1958 by Modigliani and Miller. That year, they published a paper called Cost of Capital, Corporation Finance, and the Theory of Investment. In that paper, they derived the mathematical formula for the cost of capital as a linear combination of cost of debt and cost of equity. It provides a new way to compute asset value. However, different methods of computing asset values often provide different answers. This is usually attributed to oversimplifications in cash flows. However, it is hard to imagine why simplification in cash flows will lead to different answers. Different methods use the same set of cash flows. Could it due to theoretical problems? Section 1. An example. Suppose your investment is valued at $1,000. You borrow $300 from a bank or from the capital market to finance the investment. The bank owns $300 of your investment. You, as the equity owner, own the rest, $700. The value of the total investment, $1,000, is the sum of equity, $700, and debt, $300. Debt owners have priority to receive cash flows from the investment. The equity owners receive the residual cash flows. Risk of dividend payments for the equity is higher than the risk of coupon payments for the debt. As a result, expected returns from equity is higher than the expected returns for debt to compensate for the higher risk. Suppose the interest rate of debt is 4% per year. The cost of debt is 4%. The dividend yield for the equity owner is expected to be 8% per year to perpetuity. The cost of equity is 8% per year. The cash flows to debt owners and equity owners are separate. The discount rates of debt and equity are different. But we can also think the total cash flows from the investment as a whole. It would be nice to have a single discount rate for the total cash flows. What would be the discount rate for the total cash flow? Modigliani and Miller theory provides the answer to this question. It is the theoretical foundation of corporate finance. In this chapter, we will explore this question and its answer. Section 2. Cost of capital and introduction. Investment assets are generally financed with equity and debt. The value of an asset is the sum of its equity and debt. Equity and debt can be valued separately. They are valued with equity and debt cash flows, discounted by equity discount rate and debt discount rate, respectively. When equity and debt of a company are publicly traded, we can observe the market values of equity and debt of a company. An asset can also be valued directly with the total cash flows of the asset discounted by a single discount rate. In finance theory, this discount rate is called WACC, weighted average cost of capital. Now let's give the formal definition of WACC. Suppose V is total value of an investment asset. S is its equity part of the value. D is its debt value. Then V, the total value of the asset, is equal to S plus D, equal to its equity value plus its debt value. The sum of the values of equity and debt is equal to the value of the whole investment asset. Suppose R is the discount rate of the debt cash flows. RS is the discount rate of the equity cash flows. Rho is the discount rate of the whole asset cash flows. Then rho is equal to D over D plus S times R plus S over D plus S times RS. So here, rho is the weighted average of R and RS. This is the formula for WACC. Modigliani and Miller theory introduced a new method to value investment assets. It values an investment asset by summing all cash flows with a single discount rate, WACC. Previously, assets can also be valued as the sum of equity and debt. If the new method from M&M theory is correct, two methods should yield the same result. Do they? We will look at some numerical examples first. Then we will make theoretical derivation. Section 3. Numerical examples. We will calculate asset values of investments with some numerical examples. This will help us gain more intuition. Debt owners get first claims on the asset. Their cash flows are safer than that of equity owners. As a result, discount rates on debts are lower than the discount rates on equities for the same assets. Example 1. A company will distribute $3 million coupon to bondholders each year. The principal of the bond is $100 million. The bond matures in 10 years. The company is expected to distribute $3 million dividend to equity holders next year. Assume the growth rate of the dividend is 0% per year. The market value of the bond is $100 million, and the market value of the equity is $60 million. We got several questions. What is the cost of equity for this company? What is the cost of debt? What is the weighted average cost of capital of this company? What is asset value of this company calculated from discounting by WACC? What is the asset value as the sum of debt and equity? Are two values the same? Solution: the bond price is equal to its par value. The cost of bond is the amount of coupon divided by its principal. It is 3 divided by 100 equal to 3%. The dividend yield of equity is dividend divided by its market value. 3 million over 6 million equal to 5%. The cost of equity is dividend yield plus growth rate is equal to 5% plus 0% equal to 5%. And the WACC is equal to 100 over 100 plus 60. This is the weight of the debt. Times 3%. This is the cost of debt. Plus 60 over 100 plus 60. This is the weight of equity. Times 5%. This is cost of equity. It is equal to 3.75%. Next, we will calculate asset value according to WACC. There are two parts. The first part is the debt value, and the second part is the equity value. And in that part, there are two parts. The first part is the 10 coupon values. The second part is the value of the principal discounted to the present. So from this formula of annuity, we can calculate. So the first part is from year 1 to year 10. There are 10 cash flows discounted by WACC 3.75%. And so the cash flow is coupon is 3 million. And we can calculate that. And then we add to the $100 million at 10th year, discounted by this WACC for 10 years. Finally, we add up $3 million dividend from equity to perpetuity. It is equal to 3 over 3.75%. And the final answer is $173.84 million. The sum of debt and equity is 100 plus 60 equal to $160 million. So the asset value calculated from WACC is 173.84. This is bigger than 160. The value of debt plus equity. What is the problem here? We need to assume debt will be rolled over to perpetuity. Now let's redo the calculation. Asset valuation by WACC with debt rollover. With debt rollover, cash flows from debt will be $3 million per year to perpetuity. Total cash flows from asset per year is $3 million from the debt plus $3 million from the equity, which is equal to $6 million per year. The asset value measured by free cash flows discounted by WACC is 3 plus 3, which is $6 million cash flow, discounted by 3.75%. This is the WACC. We add to infinity and it's equal to 6 over 3.75%. And the result is 160 million. This result is the same as the sum of equity and debt. Example 2. A company will distribute coupon amounts to $3 million to bondholders and dividend amount to $3 million to equity holders next year. The perpetual bond has a peculiar arrangement. Its coupon rate increases 2% every year. The market value of the perpetual bond is $100 million. The market value of the equity is $50 million. Assume the growth rate of the dividend is 2% per year. Here we see the growth rate of coupon rate and growth rate of dividend rate is the same at 2% per year. We ask the same question as in example 1. What is the cost of equity? What is the cost of debt? What is WACC? What is asset value calculated from discounting by WACC? What is asset value as the sum of debt and equity? Are these two values the same? So they're exactly the same questions from example 1. Solution. Suppose the cost of bond is R, or we say the discount rate of the bond is R. The value of the bond is 3. 3 is the payment for next year, right? Divided by R minus 2%. Here 2% is the growth rate of the coupon payment, which is equal to 100, the market price of the bond. We solve the equation to get R equal to 5%. The dividend yield of equity is dividend of 3 million, equity price 50 million, so 3 divided 50 is equal to 6%. The cost of equity is equal to dividend yield plus growth rate, which is 6% plus 2% equal to 8%. WACC, weighted average cost of capital, is equal to 100 over 100 plus 50. That is the weight of debt times 5%, which is the discount rate of debt, plus 50 over 100 plus 50. This is the weight of equity times 8%. This is the equity discount rate. The result is 6%. Now we calculate asset value according to WACC. So we have cash flows from debt and equity. So they are the same, right? Both are 3 times 1 plus 2%, the power of I minus 1. So 3 is the first year, and growth rate is 2% every year. So they add up to infinity, from 1 to infinity, and discounted by 6%. This is the WACC. So 1 plus 6% to the power of I at year of I. And we can simplify it, and you get the answer is 150. So asset valuation from WACC is 150. Now we calculate asset value as the sum of debt and equity, which is 100 plus 50 is equal to 150. So the asset value calculated from WACC is the same as the value of debt plus equity. When the growth rates of coupon payments and dividend payments are the same, asset value measured by free cash flows discounted with WACC gives the same answer as the sum of equity and debt. Now let's do example 3. A company will distribute coupon amounts to $3 million to bondholders and dividend amount to $3 million to equity holders next year. The market value of the perpetual bond is 100 million, and the market value of the equity is 100 million. Assume the growth rate of the dividend is 4% per year. We ask the same questions as before. What is the cost of equity? What is the cost of debt? What is WACC? What is asset value calculated from discounting by WACC? What is the asset value as the sum of debt and equity? Are two results the same? Solution. The cost of bond is coupon rate divided by the principal, because it is a par bond. So it's 3 divided by 100 equal to 3%. The dividend yield of equity is 3 million. This is dividend divided by 100, that's market price, equal to 3%. The cost of equity is equal to dividend yield plus growth rate, which is equal to 3% plus 4% equal to 7%. WACC is equal to 100 over 100 plus 100. This is the weight of debt times 3%. This is the debt discount rate plus 100 over 100 plus 100. This is the weight of equity times 7%. This is the cost of equity. The result is 5%. Asset value according to WACC. So we have cash flows from debt plus equity. From debt is 3 million. The equity is 3 times 1 plus 4% to the power of I minus 1. So the equity is dividend payment grows at 4% per year, and divided by 1 plus 5%, which is WACC, to the power of I. This means ith year. And we sum all these terms from 1 to infinity. And here we can separate them into two terms. The first term is the value of debt payment discounted by WACC. The second is the value of equity payment discounted by WACC. So the first term is 3 over 5%. You get 60. The second is 3 over 5% minus 4%. Here 4% is the growth rate of dividend. So the answer is 300. Two terms add together, we get $360 million. The sum of debt and equity is 100 plus 100 equal to $200 million. So the asset value calculated from WACC is 360 over 200 equal to 1.8 times the value of debt plus equity. So from this example, we see that discounting by WACC overvalue asset for growth firms. We assume the growth rate is 4%. Right? So it will overvalue growth firms. Now let's look at the final example. Example 4. A company will distribute coupon amounts to $3 million to bondholders and dividend amount to $4 million to equity holders next year. The market value of the perpetual bond is $100 million, and market value of the equity is $50 million. Assume the growth rate of dividend is negative 2% per year. So this firm is a declining firm. We ask the same questions again. What is the cost of equity? What is the cost of debt? What is WACC? What is asset value calculated from discounting by WACC? What is asset value as the sum of debt and equity? Are two results the same? Solution. The cost of bond is 3 million divided 100 million is the coupon rate divided by the principal is equal to 3%. The dividend yield of equity is 4 million is dividend divided by 50, which is market value, equal to 8%. The cost of equity is equal to dividend yield plus growth rate, which is equal to 8% minus 2%, equal to 6%. WACC is equal to 100 divided by 100 plus 50. This is the weight of debt times 3%. This is the debt discount rate plus 50 over 100 plus 50. This is the weight of equity times 6%. This is the cost of equity. The answer is 4%. Now we will calculate asset value according to WACC. So we have total cash flow, which is 3 from the debt plus 4 times 1 minus 2% to the power of I minus 1. That's the equity part. It declines 2% every year, discounted by 1 plus 4% to the power of I. So that's the discounted by WACC. And we sum from 1 to infinity. And we separate them into two terms. One term is debt, the other term is equity. And the first term, debt, is 3 divided by 1 plus 4% to the power of I from 1 to infinity. And the answer is 3 over 4%. And to the equity part, it's 4 times 1 minus 2% to the power of I minus 1 divided by 1 plus 4% to the power of I. That's the WACC discounting. We add terms from 1 to infinity. We add them together, which is equal to 4 divided by 4% minus negative 2%. And we add these two terms together, we get $141.7 million. Sum of debt and equity is 100 plus 50, which is equal to 150 million. So the asset value calculated from WACC is less than the value of debt plus equity. This means valuation by WACC undervalue assets for declining firms. Comments. From the earlier examples, we can see that asset value with WACC method often differs from the other valuation method of asset as the sum of equity and debt. This is often attributed to simplified assumptions about cash flows. Could there be problems with the theory itself? We will look into the theoretical foundation of corporate finance. Section 4. Review of the theoretical foundation. The theoretical foundation of corporate finance is very simple. It mainly consists of a single paper by Modigliani and Miller. It was titled The Cost of Capital, Corporation Finance, and the Theory of Investment. It was published in the American Economic Review in 1958. It is a great paper. It is very clearly written. I recommend everyone to read it. Historical background. At that time, Merton Miller was a young faculty member at Carnegie Institute of Technology, now Carnegie Mellon University. He was sitting at a class of Modigliani, who was 5 years older than Miller. After class, he asked Modigliani about a good research topic. Modigliani told him about work he didn't finish. He gave to Miller, and Miller finished the work. That was the famous M&M paper. Most of the foundational works in economics and finance are done in the 1950s and the 1960s. In investment theory, portfolio theory was developed by Harry Markowitz in 1952. CAPM was developed by William Sharpe in 1964. In economics, the mathematical foundation of game theory was developed by John Nash in 1950. The mathematical model of general equilibrium theory was developed by Kenneth Arrow and Gerald Dabur in 1954. In a very short window of time, the foundation of modern economic and finance theory was established. Wag, in the MM paper, Modigliani and Miller derived the formula of weighted average cost of capital, WACC. WACC is often used to value investment projects. It is a very important discount rate. The cost of capital is a fundamental concept in finance. MM paper is the most important paper in corporate finance. Both Modigliani and Miller got Nobel Prizes in economics. There are three major propositions in this paper. We will go over them separately. Proposition 1 of MM paper. V is equal to S plus D equal to X bar over rho. Here V is the value of whole investment project. S is the equity value or stock value. D is the debt value. The sum of equity and debt is equal to the value of the whole project. This means V is equal to S plus D. X bar is the expected cash flow per unit time. Rho is the discount rate. The expected cash flow per unit time, X bar, is assumed to be constant to perpetuity. The value of the project is equal to the expected cash flow per unit time divided by the discount rate. This means V is equal to X bar over rho. Proposition 2. The relation among equity discount rate of the levered firm, RS, the debt rate, R, and discount rate of the unlevered firm, rho, is RS is equal to rho plus rho minus R times D over S. Rearrange the above equation, we get rho equal to D over D plus S, this is the weight of debt, times R, plus S over D plus S, this is the weight of equity, times RS. This is the formula for WACC, weighted average cost of capital. Some comments. We can observe the debt rate R from the market data. We can calculate the equity discount rate RS from market data with CAPM or other theories. WACC, rho, is not directly observable. It has to be inferred from market data with M&M theory. Proposition 3. An investment project should be undertaken if and only if the expected rate of return of this project is as large as or larger than the cost of capital. Empirical works. There are different valuation models for assets. It is well known that valuation from Modigliani and Miller theory may differ from other models. What is our opinion about the differences in valuation? A representative opinion. In principle, the free cash flow approach is fully consistent with the dividend discount model and should provide the same estimate of intrinsic value. This was demonstrated in two famous papers by Modigliani and Miller. However, in practice, we will find that values from these models may differ, sometimes substantially. This is due to the fact that in practice, analysts are always forced to make simplified assumptions. This is a quote from a standard textbook on investment by Bode and others. Questions about MM paper. All the results in MM paper, including the formula of WACC, are obtained when the expected payoff from the investment project is assumed to be constant to perpetuity. If this assumption is not true, will the results stay? Miller and Modigliani themselves had warned against drawing broad conclusions from special cases. They said in a 1961 paper, "This is merely one of a number of peculiarities of this special case on which, unfortunately, many writers have based their entire analysis. The reason for the preoccupation with this special case is far from clear to us. Certainly no one would suggest that it is the only empirically relevant case. Even if the case were in fact the most common, the theorist would be under an obligation to consider alternative assumptions. We suspect that in the last analysis, the popularity of the internal financing model will be found to be reflect little more than its ease of manipulation, combined with the failure to push the analysis far enough to disclose how special and how treacherous it really is. Or obligation. Certainly, no one would suggest that constant cash flow to perpetuity in MM paper is the only empirical relevant case. Even if the case were in fact the most common, we would be under an obligation to consider alternative assumptions. Some further hint. In bond pricing, there is an adjustment called convexity. This suggests that discount rate is a nonlinear factor, but WACC is a linear combination of two or more discount rates. Could there be problem for WACC for general cash flows? In next section, we'll make some formal derivation. 5. Theoretical derivation. We assume an investment project is financed with debt and equity. The coupon payment from debt changes at the rate of K per year. The dividend payment from equity is expected to change at the rate of G per year. The asset value, V, is the sum of debt, D, and equity, S, or V is equal to D plus S. The value of an asset is also defined as total cash flows discounted by WACC. Let V prime represent the asset value calculated from this definition. We can derive that v prime minus v is equal to v prime minus d plus s is equal to a times g minus k. Here a is a positive coefficient. And from here we can see that the two definitions are equal only when g is equal to k. For more information, for detailed mathematical derivation and systematic discussion, please refer to the following paper on the theoretical foundation of corporate finance. When k equal to g, investment valuation from cash flows discounted by WACC gives the correct answer as the sum of debt and equity values. When k is equal to g, debt equity ratio is constant over time. This means that MM theory is valid when debt equity ratio is constant over time. In all other cases, cash flows discounted by WACC give incorrect answers. When G is larger than K, investment valuation from cash flows discounted by WACC overvalue investment projects. When G is less than K, investment valuation from cash flows discounted by WACC undervalue investment projects. Conclusion: Modigliani and Miller theory is not valid for more general cash flows or more general capital structures. Modigliani and Miller theory often overvalue growth firms and undervalue value firms. Our derivation shows that the problem in misvaluation is caused by simplified assumptions in Modigliani and Miller theory, not by simplified assumptions in practice. Section 6. Further discussion. Assume the coupon payment from debt is constant. This is the most common case in practice. When G, the growth rate of dividend, is positive, WACC method will overvalue the asset. When G is negative, WACC method will undervalue the asset. Only when G is 0, WACC method will provide correct value of the asset. This is the case in Modigliani-Miller's paper. More generally, when the growth rate of dividend is higher than the growth rate of coupon, WACC method will overvalue the asset. When the growth rate of the dividend is lower than the growth rate of the coupon, WACC method will undervalue the asset. When the growth rate of dividend is equal to the growth rate of coupon, WACC method will value the asset correctly. And that's the only case WACC method will value the asset correctly. Now let's discuss empirical results. Empirical investigations show that growth stocks are often overvalued and the value stocks are often undervalued. We usually attribute this pattern to investor irrationality, but this pattern can also be caused by Modigliani and Miller theory, which is the theoretical foundation of one of the commonly used valuation methods. Growth companies, which have high G, are overvalued with WACC method, and the value companies which have low G are undervalued or relative undervalued with respect to higher G companies. Misvaluation due to WACC method may contribute to the patterns of misvaluation of growth and value companies. We sometimes choose different WACC numbers for different years to obtain correct asset values. But if WACC change every year, some commonly used concepts in corporate finance, such as the cost of capital and expected return for projects, become difficult to apply. Furthermore, it would be difficult or impossible to determine the values of WACC of each year from market data. In practice, WACC is sometimes chosen so cash flows discounted by this number will be equal to the asset value. In example 3, the correct discount rate would be 6%. 3 over 6% plus 3 over 6% minus 4% equal to 50 plus 150 equal to 200. This is the sum of debt and equity. But this rate is not obtained as a weighted average of debt and equity discount rate. It is not really WACC. On the concept of cost of capital, if WACC does not provide accurate discount rate for measuring investment value in general, should we still use Proposition 3 in MM paper as criterion to make investment decision? Does the concept of cost of capital give more smoke than light? When we use WACC, are we adding oranges and apples together? Should we keep using the concept of cost of capital? We can return to equity valuation as the criterion of an investment. Instead, investment projects can be valued by residual claims for equity owners, discounted with expected returns for equities. This is more consistent with the statement that investment should maximize equity value or shareholder value. Maximizing asset value and maximizing equity value are not always consistent with each other. Section 7. A personal account. Many years ago, I was learning corporate finance for the first time. I couldn't understand the rationale behind the formula of WACC. WACC is a linear combination of two or more discount rates. The relation between asset value and discount rate is non-linear. I have some concerns about the formula. I read the original paper by Modigliani and Miller and found out that Modigliani and Miller derived the WACC formula only for a very special case, constant cash flow to perpetuity. One naturally asks, is Modigliani-Miller theory valid for more general cash flows or more general capital structures? But on second thought, many people have used MN theory for such a long time it must be valid for more general cases. Like most other questions in my life, I left there and did no more investigation. As a finance teacher, I need to teach Modigliani and Miller theory again and again. Over time, I grew more and more uncomfortable teaching something I don't understand. In the end, I sat down and derived the whole thing again. The results are recorded in the course notes. They are discussed in great detail in my various papers over the years. theory, as the very foundation of corporate finance, has been established for more than half a century. It is difficult to examine the very foundation on which the whole profession established their work, career, and reputation. The last section: possible presentation topics. 1. Use systematic numerical simulations on various cash flow scenarios and financing options you can imagine to find out more about how theory affects valuations in different scenarios. 2. Find a specific company. Calculate values of assets with two different methods. The first as the sum of debt and equity. The second as the sum of cash flows discounted by WACC. Are they the same? If not the same, can you find investment opportunities? 3. Further explore the theoretical foundation of corporate finance.